Shibani, with the massive FIS selling and the degrowth in SIP, do you see a further correction?
So markets have had a volatile time. The volatility in the market has been a factor of what's happening globally, especially given the uncertainty on tariff, geopolitical issues, and the like. And on the domestic front, our earnings growth has slowed down. So if you've seen the numbers over the last few quarters, you've seen mid-single digit earnings growth. This, together with valuations and pocket having been high, has impacted the market. Now, near term, we would continue to expect some degree of volatility based on all of these factors that we spoke about. However, when you look ahead into FY26, we expect that earnings growth should start to improve, and we are now expecting on a consensus basis mid-teens earnings growth for Nifty 50. We also expect some pickup as far as government spending is concerned, all of which should help support growth. However, we also have to be cognizant of what's happening globally, and that will have a bearing on the market. So structurally, while we continue to be positive in the medium term, near term, I think we will have to contend with some degree of volatility.
Okay, what's your take on the valuations, and is it a buy on low market, buy on dip?
So absolutely, I think valuations is a factor that we need to look at. When you look at different segments of the market, today large caps are trading on a 1-year forward price to earnings basis, largely in line with their long-term average multiples, which means that for large caps, valuations appear reasonable. Mid and small caps, however, are still trading at about 20 to 30% premium to their long-term average multiples, which means that valuations remain elevated in that pocket. So at this point in time, from a risk-reward perspective, we continue to favor large caps over mid and small caps. Where mid and small caps are concerned, one has to be extremely stock-specific and bottom-up in terms of portfolio creation, looking at quality and reasonable valuations.
Which sectors are you bullish on?
So at this point in time, especially post the budget, given the fact that the budget has given a boost to middle income as far as the overall segment is concerned, some segments of low ticket consumer discretionary is a segment that we are looking at. It could include retail, it could include two-wheelers, for instance, anything that is consumer discretionary. We are also fairly positive on large cap banks, specifically the private sector banks where valuations are again reasonable. We are positive on two other sectors, which is technology, as well as parts of healthcare, which is more domestic, specifically the domestic formulations business and hospitals.
With respect to US tariff implications, which are the sectors you feel will be positively and negatively impacted by the same?
Actually, we'll just have to wait and watch, because as far as tariffs are concerned, when you look at India, the amount of impact that India has, or the contribution of India in terms of the imports that US gets from India is a very small portion. However, if the reciprocal tariffs happen, then certain sectors could get impacted. But as you know, that the final outcome in terms of how much tariffs, which sectors, I think we just have to wait and watch, because that's evolving pretty much on a day-to-day basis. But this is something that is a risk for the markets, and that's something that we are cognizant of. And therefore, obviously, sectors where India has large exports to the US, where tariffs are also high, would be impacted. But
IT and banking?
no, banking not at all, because banking is mostly a domestic sector. IT, I would not be so worried, because IT is largely services, but segments, for example, like automobiles, auto ancillaries, chemicals, to some extent pharmaceuticals, where we do a lot of exports, which is US generic drugs. These are sectors we would wait and watch for. But I would think that the overall environment on tariffs is evolving. It's evolving on a daily basis. So it's just too early to comment and say that this sector would be impacted and this would not be.
So people would like to know that what does an ideal portfolio in volatile markets, how should it look like?
So I think one must be, even in volatile markets, extremely disciplined. Continue with your SIPs, because that is how you create long-term wealth. At this point in time, as we said, from a portfolio asset allocation perspective, what we are suggesting is be neutral to equities as an overall asset allocation bucket, slight tilt towards large caps in the portfolio, slight underweight on mid and small caps.
And with respect to gold, gold ETFs have really picked up. Should we increase the gold allocation in the portfolio, the investors?
So I think gold should be part of your asset allocation bucket. Of course, gold as a asset class has done well, but when you look at last, say, many years and history, every year different asset classes, do well. Some asset classes don't do well. Keep your asset allocation intact. Within the asset allocation bucket, whatever you have decided in terms of allocating to gold should continue, because gold finally is a hedge against inflation as well as volatility. However, keep your overall risk profile, your investment goals in mind while you're creating your asset allocation bucket.
Thank you so much. Thank you, Shibani.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.